This is Great FM. Great FM.
Hello, everyone. You've tuned into Great FM with me, Ahalya, another edition in the podcast series from Great HR. Now, all roads lead to one thing on this series, and that is HR and the different interventions that an HR professional may have to make through the course of their professional careers. These episodes explore HR practices, the different actors in the business that could impact the world of HR, and how, HR teams all over need to navigate the waters in certain scenarios. Now, one thing none of us can ignore, a thread that binds all of us together, is taxes. Taxes make some people feel happy and some people feel not so happy. Taxation laws, regimes, policies impact every business, no matter which part of the world is in question. In fact, India was recently faced with a new tax regime, and old and new tax regime, both now coexist. And historically, taxes have been confusing enough. I think, again, this is something we can all relate to. So we're definitely going to need some help contextualizing and breaking this down so we can understand ultimately how it impacts the functioning of HR. To lend us that helping hand, please welcome CA Amarnath Ambati, co-founder of Arush India, to the podcast. Hello, how are you doing, Amar?
I'm doing good, Ahalya. How about you?
Doing very well. I really hope you're going to, completely break down this tax regime for us, Amar, so we are better equipped after this podcast series, because like I said, taxes are intimidating enough, right? Without...
Definitely. Yeah.
So I'm sure you get this a lot, given how engaged and involved you've been with so many different taxation policies, globally, that too, not just with India. So why don't we start a little bit simple? Could you tell us the key highlights of the new tax regime so we have a good starting point?
Great. Yes, definitely. Coming to the new tax regime, the regime was introduced in 2020 budget. Mm-hmm. So it was applicable from the financial year 2021. The people of India has seen 2 years with this both new and old tax regimes. So the major objective as to why this new regime was introduced by the finance minister was to simplify and rationalize the tax provisions. Okay. So when I look into the old provisions, there were so many deductions and exemptions, mm-hmm. and which are not there in the new regime. And when you go through those deductions and exemptions, there were lots of conditions, ifs and buts were attached to those deductions and exemptions. Right. And another major drawback of those deductions and exemptions are the supporting documents or the proofs which an individual or a HR person or a payroll person have to maintain to ensure that the employees are claiming the right exemptions and deductions, mm-hmm. were humongous. So in order to ease all these difficulties, they introduced a new regime which does not grant any of these deductions and exemptions, but however, they do provide a relaxed tax rates. The tax slabs are relaxed. So comparatively, new and old regime, the new regime, I would say it is more tax beneficial. However, at the same time, the government withdraws many deductions and exemptions, which are not applicable in the new regime.
Okay, all right. I think that's a good foundation. They always say the foundation is the most important part. And I can only imagine that being true when it comes to a conversation about taxes. So you did touch upon this briefly, the key differences between the old and new regime. But if you could, in more detail, sort of map those out for us, I think that would be helpful as well.
Yes, definitely. So the key differences between old and new regime, the first and the foremost is with respect to the tax rates. Mm-hmm. I said the tax rates are relaxed in the new regime. So what does that exactly mean? So when you look into the old regime, in excess of 10 lakhs, if the income is exceeding 10 lakh rupees, the tax rate applicable is 30%. Mm-hmm. Whereas in the new regime, the 10 lakhs becomes 15 lakhs. So in the new regime, if the total income exceeds 15 lakhs, the applicable tax rate goes to 30%. When you look at the entire slab structure in the new regime is up to 5 lakhs, there's no difference. So 5 to 7.5 lakhs, it is 10%. So 7.5 to 10 lakhs, it is 15%. So mm-hmm. 10 to 12.5 lakhs, it is 20%. 12.5 to 15 is 25%. And above 15 lakhs is 30%. Mm-hmm. That is one major difference. The other differences, again, I touched upon that many of the deductions and exemptions are withdrawn in the new regime, which were otherwise available in the old regime. Just to name a few, like it could be HRA exemption, LTA exemption, Chapter 68 deductions such as PF, PPF, NSC, insurance. So the list goes on. We will discuss this in detail in our discussion today.
Okay, all right. And, at a glance, again, you did touch upon this a little bit, but I think it's more nuanced than just black and white. What are some of the main pros and cons of the new tax regime? Things that allow for a more elevated experience and things that allow for a little bit more difficulty with this new regime?
Yeah. Okay. Good question. Very good question. So coming to the pros of this new regime, of course, beneficial rates is one of the important aspect which everyone needs to look into. The other one is reduced documentation for both employer and employee. I mean, I also mentioned while discussing key highlights that there's a humongous amount of exercise which is involved at the year end by HR and payroll departments with respect to these proof collection and retaining those for record purposes. So that's a major relax to both employees and employers with respect to new regime. But coming to the cons of it, of course, again, exemptions and deductions need to be foregone. Apart from that, there is also implications from the set off and carryover of losses in case of new regime. Especially the house property losses will not be allowed to be set off with any other income. At the same time, it won't be allowed to be carried forward as well. So, I mean, in sum and substance, house property losses will need to be completely foregone by the employee when he chooses the new regime.
So you also said that you were going to take us through, the deductions and exemptions in a lot more detail. I hear that there's actually quite a few that we need to go through. So why don't we get started on that road?
Let us start with the exemptions. So when it comes to exemptions, it could be allowances or perquisites. Let us discuss about allowances.
Okay.
Allowances, the very first thing which I commonly come across with in any salary structure is the house rent allowance.
Right.
And also, when you look at the employees, there would be a lot more beneficiaries of this exemption, especially the current new generation and the new joinees, basically, they will not be having their own houses. Obviously, they will be staying in a rented premises. And this is one of the major benefit or exemption, I would say, where employees would be looking forward in any of the salary structures. So under the new regime, this house rent allowance is excluded. I mean, the employee cannot opt for this exemption, though he is paying a rent for a house which he is living in. Similarly, there is another exemption called leave travel concession. Leave travel concession is for traveling within India to a home country or for a vacation. So even that leave travel concession is not available under the new regime. Another important aspect when it comes to perquisite is, which is, I mean, generally I won't see that anybody will notice that also. It's a very small amendment which they have introduced in the perquisite rules, basically the food coupons. So many companies will issue the food coupons to facilitate buying of food for the employees. So that food coupon exemption of 50 rupees per meal where the companies are paying, even that will not come as an exemption in case of new regime. Food coupon will be completely taxable. So then another important area of things to be looked into is the deductions to be foregone. Now we discussed exemptions, that what are the deductions which need to be foregone. The first and the foremost is the standard deduction of 50,000 rupees for salaried employees. It's completely gone. So that's not available in the new regime. So then again, deduction towards professional tax paid. Every month the employees have to pay 200 rupees as professional tax. Even the deduction towards payment of those taxes is not available in the new regime.
Okay.
So then deduction for Chapter 68 deductions, what we call it as, which has a limit of 1,50,000, which comes under Section 80C, which could be life insurance premium payments, housing loan principal repayment, tuition fee for children, investment into public provident fund, NSC, then medical insurance premiums, then employee contribution towards NPS, and also deductions towards donations given to charitable institutions. Nothing is allowed as a deduction under the new regime. And there are a couple of points which need to be looked into when the employee is opting for new regime. So there are two important deductions which are allowed, though the employee is opting for new regime. What are those deductions? Or employer contribution to NPS is allowed as a deduction even under the new regime. I mean, employer contribution to NPS. It's not employee contribution. It is employer contribution to NPS is allowed as a deduction. Then there are some couple of special allowances which are given to a Divyang employee for commuting between residence and office. So even that is not disturbed with. It is again allowed as an exemption. Then there are some special allowances, such as if your person is making a business travel, either it could be a domestic business travel or an overseas travel, companies will pay per diem to take care of their living expenses. So that per diem is again exempted under the new regime.
Fantastic. Well, off the cuff, though, I do have a question for you, Amar. I want to kind of understand, given the current economic scenario, right? It is one that is worrying everyone. It is one that is concerning. And I'm sure governments all over the world are bracing themselves, right? They have to, in order to ensure safety and security. Do you think this new tax regime came in at a good time for us? Or do you think it's going to be a little bit difficult now for us to make everything work at the same time?
I do not see any challenges there. I would say that this has come in the right time. I mean, when you look at the past, I mean, how this has been introduced, the legacy goes on 10 years before. In 2009, government thought of introducing a direct tax code. In that direct tax code, I mean, this was proposed. Ultimately, that code was not rolled out and did not come into effect at all. That's a different thing. But this has been going on from past decade, I would say, that whether we need to simplify the regimes or not to simplify the regimes. And another point, when you look at the global trend, I mean, as you rightly pointed out, many countries are towards the direction of simplifying their tax laws. Everyone wants to keep the things very simple, especially when it comes to individuals. They do not want to complicate at all. So even US came forward in 2016 and they made a lot of changes in their tax laws and they made it very much more simplified compared to the erstwhile tax regimes. I mean, India also has followed the global footprint. So I would say that, we are moving in the right direction from an economic standpoint of view.
All right. Point noted. Well, Amar, I think this is honestly just the tip of the iceberg when it comes to this conversation. So part 2 is definitely guaranteed. We now have to actually explore how the new and old tax regimes, especially coexisting, will affect the world of HR. So we're going to hold our horses and continue this conversation in the next part. Do you think that works?
Oh, definitely. Why not?
Fantastic. Well, this is it for part 1 of this conversation on Great FM, folks. Amar and I are going to be back in conversation very, very soon. Make sure that you check that out as well. Catch you in a bit.
This is Great FM.